Economists look at the stock market and they see it going up and down. And they're asked by reporters to explain why it goes up and down. And usually they don't have the foggiest notion why it went up or down.
You know, I really thought Bob there was gonna say a different F word than foggiest. But I guess when you go by Robert, you gotta keep it classy. In this video, Robert Shiller, along with me, AK from Fallible, are gonna explain why economists and all their models and predictions are just BS. And how do I know that? Well, I'm an economist. And I know you're probably shocked, like, AK, how can you be an economist? But it's true, I got an economics degree from the University of Michigan. Great school, but kinda a stupid program though. And let me tell you when I realized that econ wasn't all that it was cracked up to be. So our econ department was right next to the business school. Now the business school had a ton of money coming into it all the time. So they were just building and building and building all these beautiful structures. They had their own private chef and the students would just run around throwing $100 bills at each other. Now the econ building, which was right next to it, was this dark place with no windows, except for the ones that you could see the business school from. And for some reason, everything was just flooded all the time. One time I was in office hours in my professor's office like, "Professor, my feet are wet." "Well, I guess your toes utility aren't being maximized much, are they, huh?" And that's why our department is poor and nobody likes us. Yeah, so it wasn't great being an econ major, but you know, the basic classes were pretty important, like the 101s and the 102s, and I learned a lot there. But the problem was when you got into the more advanced classes where you're actually building models with calculus and doing econometrics and all that stuff, you got real complicated stuff going on that doesn't even work because it breaks down. And the reason these things break down is because the #1 assumption in economics is that every person is rational. And as we know, people are not rational at all. Rob knows too.
In an era when the consensus view was we should just assume that people are rational utility maximizers and rational forecasters, Bob was very skeptical of that.
It's actually instructive and entertaining to think, imagine the world were filled with really smart people who were all mathematically inclined and really spent serious effort processing the data. What would it look like? But then let's get real, you know, I'm not like that. You're not like that.
Good old Rob, always keeping it real. So like I said, humans are not rational, they're emotional. And you've seen reality TV, you know how crazy people can get. Do you think those people on MTV are the same people that are gonna fit into these economic models? Of course not. And I've done so much content on this channel about why we as investors and traders can't follow our stop losses, we chase opportunities, we experience FOMO, and all these emotional things that make us do stupid, non-rational stuff. And the stuff that we do and the things that we do are not only non-rational, but they're pretty crazy. Oftentimes they go directly against our best interests. So how are you gonna model off of that? On top of that, because we're not all rational and we're not all exactly the same, we all interpret information differently. And you know what I mean, you've seen those pictures where they look like one thing to one person and another thing to another. Like that one picture of the duck. And I mean, I see a duck, but I think other people see a beautiful woman. And you know, that shows how two people are interpreting the same piece of information differently. And it also shows how the other person is sexually attracted to ducks. And the way we all interpret information differently is why I could see an earnings report and I could label it as great, but for some reason the stock price drops anyway. So clearly the market didn't agree with my evaluation. If we were all rational and evaluating things the same way, that wouldn't happen. And another example is the media, who's always saying one thing about the market while the market does the complete opposite. Just like all the bears right now as the market keeps climbing higher. But all of this is what makes a market, right? People with different opinions going at it and betting against each other is how we get price discovery. If everyone was rational and thought the same way, well, there wouldn't be any of that, would there? In this next clip, Rob talks about how some of the most successful people are looking at the market in very different ways.
There was a poll recently of what great finance theorists had in their portfolios. And it was all over the map. They had no agreement. It was still just intuitive judgment, even for the greats themselves. It reflects something hard to quantify about the human mind. Fortunately, we're human.
So the moral of the story is, don't think like an economist. Really, you're better off thinking like a psychologist. People are what make markets, and people are irrational. So don't try to fit them into some model that demands rationality and then be surprised when it doesn't predict anything. The whole reason we got booms, busts, cycles, and trends is because of people being irrational. So the best way to make money is by playing those people, or as we call it, playing the player. Figure out what they're thinking and then stay one step ahead of them. Hey, if you like this video and learned something from it, make sure you subscribe to our channel and hit that bell for notifications of new videos. We release 3 a week, all market related. So subscribe and I'll see you in the next video. Stay fallible out there. Bye.